So let's look at some examples now to give you an idea of what you could achieve. And this is an obvious one. It's the NASDAQ 100 daily Heikin-Ashi chart. I've just got an adapted DMI indicator on there, a Bollinger Band, a moving average, but you can see those boxes in the middle there. That's the key to this course. That's the Darvas Box strategy, and we're going to learn how you get in the trades, how you get out the trades, how you build a position, how do you size up and make it a more effective, profitable strategy. All of that is within the course, but you can see just visually how effective this process using Darvas could be. Our second example is Tesla on a 4-hour Heikin-Ashi chart. Same technical analysis indicators laid on there, but this time it's a different time frame, 4 hour, just showing you how you can mix the time frames up. We've moved from an indices to a stock, and it's just another quick simple example to show you how you can build and use the Darvas Box method in your trading. Now, NICOLAS DARVAS was a trader in the 50s, actually a retail trader in the 50s, that turned $10,000 into $2 million off the back of his own strategy, and it's a really good example of studying him as how you can succeed in the world of trading and the problems of getting there. It was a very simple, effective solution to the world of trading. It's easy and to apply and learn, and you can now, with the technology around, apply this using your own technical analysis. It's a very good trend following strategy that works today. I use it personally. It works across markets, time frames, and on top of that, it's really just great for learning about trading psychology, strategy design and testing and implementation, and also we had some great trade and risk management rules. So there's a real bunch of stuff you can learn from this course. So what else? Well, you're going to get to know the ins and outs of the Darvas Box method thoroughly. You're going to learn how it's such an effective tool for your trading and how to utilize that within your own trading across markets, time frames. Like I said before, you're going to enhance and adapt what was a very good strategy and make it more relevant to today's world of trading and technical analysis. And from that, we're going to be able to build our own independent, powerful trading strategies. First of all, before we can get on to the exciting stuff of putting the strategies together, we've got to dig into some history of Darvas. We've got to understand where he came from and how he put together his theories and the struggles and the ideas that he faced and came up with and the solutions to those problems, because then we can better understand how to utilize his tool in today's world of trading. So who was he? Well, he was a Hungarian by birth, lived from 1920 to 1977. He was economically trained at the University of Budapest, and his primary occupation was a dancer, and a very successful dancer at that, travelling the world and dancing with some of the most famous people of stage and screen. But on the side, he became a self-taught investor and then author. So we would classify him as a retail trader, by no means a professional trader, because his profession was dancing. So a very unusual switch between the dancing and the investing, but for our purposes a great example of how you can succeed in the world of retail trading. Why should we bother with the Darvas method? Well, as I've already said, it's a textbook method of how to succeed in the world of trading. And remember, he did this in the 1950s, before computers, the internet, all the technologies that we have to hand today. So probably a harder experience, and one we can learn from. So as new or losing or even experienced traders, we can learn an awful amount from his approaches and methods and ideas, and we can learn how he got his edge, and it was certainly a significant edge, and hopefully back work that into our own tradings. And you might think, well, this was done in the 1950s, it's not relevant to me today. Well, you're wrong there. It's totally relevant and can be completely usable today. So how did it all start? How did this dancer become top trader? Well, it all came about in the 50s. Normally got paid cash, but this time an event in Canada in the early 50s, he got paid in shares, and he had no idea how stocks and shares work, but he took the deal, and through time these shares made money, and he was amazed by this. He sold out, pocketed the cash, and from that point on he was hooked, and he really wanted to understand how the stock market worked, and this was the start of his journey into the world of stock trading. But really, he was starting from a blank canvas. He had no idea how to find good stocks, and his first approach was really, as most of us would do, is to take the advice of others, tips, papers, television, whatever we would do now. But he lost a lot of money by doing that, so he then decided to study even harder and wanted to take on Wall Street, and he put together $10,000 worth of savings as his initial starting pot and venture into the world of trading. So he went straight to the heart of the matter, and instead of taking regional advice, he then took Wall Street advice. He wanted to learn the lingo, and he was doing okay, and he broke even at best, and he read many books such as You Can Make Money in the Stock Market, Consistent Profits in the Stock Market, ABC of Investing, and many more. He was putting together his education by reading and studying. He subscribed to stock market services, but he also found that these tipsters often contradicted themselves on the same stocks, and this left him confused. He also really liked his sayings, and he built these into his trading rules, such as you can't go broke taking a profit, buy cheap, sell dear, ones we've heard of before. And he actually decided at this point that being a fundamentalist type of trader was the way forward for him. For those that don't know what a fundamentalist is, well, fundamental analysis is the process of really determining fair value of something. Is it overvalue, undervalue, par value? And it's coming up with a way of analysing the data set to draw those conclusions. And normally this is quite a laborious process. So if you're a stock trader, you might look at newspapers, read online posts. If you're interested in shares, you might visit the company, talk to directors, check the media out, all sorts of ways, the accounts, and draw your conclusions from. And like I said, this is quite a time-consuming process, and this was the route initially that he decided to go down. He even got into trading OTC stock markets, which any time is really difficult and dangerous to do. But he devised his first strategy around what he thought directors were doing inside their companies, but he found that he couldn't act quick enough around their information, and realised that they actually didn't know the market. They knew their companies, but they didn't know the market. So there were some elements that he was starting to think about in his trading. And his own summary of his Wall Street experience to date would be that he was very overconfident, had a big ego, ambitious, always wanted to be right, and was easily led and impressed by these Wall Street suckers and the atmosphere of the whole thing. And one very important thing was that he found that he took his profits too quickly and held his losses too long, which is another fundamental problem that today's trader also I commonly see suffer from. So from these early beginnings, he developed 6 rules around the results that he had noticed. The first, don't follow the tipsters. Then be cautious of brokers' advice. Ignore those sayings. Don't trade dangerous, illiquid OTC markets. Don't listen to rumours. And his general conclusion that actually fundamental analysis was working better than pure gambling, so he was going to study it in even more detail. So as this fundamental trader, he started to create some filters around his analysis, what we would call market scans today, to try and find that right stock. And he found that these stocks didn't always follow his analysis. He put in all the hard work, expect it to go up, and it didn't. So he then added in further sector and overall market analysis, and he was looking into those strong sectors to find the best, hottest of stocks. And this more scientific approach, as he called it, actually he found out didn't work, and he lost again. So again, he was in a confused state of where he should turn next. So he was losing a lot of money fast, and he was getting very exhausted and emotionally strained by the whole thing, and was about to give up. But one stock called Texas Gulf saved him from complete disaster. And why was this? Because he actually used something called technical analysis to succeed from that trade, and he decided to dig into this idea further. And he also decided to learn how the markets actually operate and work, the rules of the game, so to speak, and come up with a process that could try and produce more constant and consistent winners. So we now come to the phase of his education that he would call the technician phase, as we know really as technical analysis. And as this technician, he realised very quickly that his competition were really the experts, and that he was going to look at and pull to pieces, I suppose, how Texas Gulf, his trade, won for him, and look for similar patterns across the stock market in America. And he noticed that another reason why this worked was that volume aided the movement and momentum of his trades. So from that point on, he was going to look at price action and volume, and to find further his stocks that he wanted to jump onto, he added in the human element, the behavioural science of trading, and he was one of the early adopters of this way of looking into how markets and participants in the markets behave to gain an advantage from. Really, he was looking for unusual activity, but again, this strategy failed. He went big and lost, and he found that he was buying at the top, and then the price would instantly reverse of him. And that's happened to me, it's probably happened to you. And he realised that each individual stock behaved differently, so his next stage of learning was to drill into this idea. More and more he was turning into this technical analyst. And what is technical analysis summarised today? Well, it's the study of market action. That could be price, volume, open interest, any other sort of data series that you can put together, primarily though using charts, and the purpose of that is to forecast or anticipate future price movement. And this can be involving all sorts of different approaches to try and gauge that sentiment, and we can use historical price data and volume to forecast the market and the trend and the momentum of prices. But the end result is that we're going to get a price level that we think the market is heading to next. Darvas though still had a lot of questions that needed answering. Ones like, how do these stocks act, how do they behave, what are their patterns, and through his analysis he did find patterns, and that there were easily recognisable trends that continued. And within these trends, sort of a bit like cycle theory, he noticed that they moved in different time frames, which he called boxes. We'd probably understand them in pure technical analysis theory as consolidation phases of a stock price or commodity FX price. He noticed that the stock price ranged between the highs and low points enclosed within what he called a box, and this was the start of his theory, but again his first attempts at trying to get this to work didn't really go that well. But what was remarkable in this whole process, that he was still doing this while being a full-time dancer, travelling the world, like I said, in an age of pre-technology, no internet communication like we had today. Remember, even air flight, the sort of planes he'd have been travelling around on, the time it took to go places, it was all over the globe. And while he was doing all this, he was doing his research, studying to become a better trader, but still being a world-class dancer. So hopefully you're starting to get a background picture of NICOLAS DARVAS and what he was up to, and to the point where he's starting to get closer and closer to finding the answer to his problems. So now we're going to dive in and just look at his strategy in a more simplistic overview. What's got to be remembered is that his theory and strategy was always work in progress until he could provide those consistent results that he was looking for. So we're going to now go over how he developed the strategy and summarise the basic rules. So let's define the strategy in a bit more detail. And these boxes that he noticed often came stacked like the blocks on the side of a pyramid, indicating a strong trend. And he liked to watch the stock in the highest box, how it was performing, and he saw that it bounced within the box. That was a good sign. But if it fell below that, he would ignore any potential setup and would be classed as more bearish. And he also noticed the time periods of these consolidation phases could last days to weeks, if not longer. So determining the range of the box was initially very important, and he tried everything, and down to even percentage sizes. And he also noticed that these stocks coiled before bouncing. And again, if we're looking at technical analysis today, we would compare that to continuation in price patterns, triangles, wedges, flags, those sort of things that we would see in standard technical analysis today. And you'd also notice that you'd get a bounce in these boxes from the top to the bottom, which shook out the week longs, I suppose the stop hunters, before rapidly returning to the upside. And the right time to buy, he noticed, as soon as the box, if it was a long trade, the box was broken at the top. He also realised that this often happened very quickly, and he didn't have the physical capability to do so. So he then added in a new rule that all his trades would be, on using orders, and especially a buy on stop entry rule order. What is a buy on stop order? Well, that's an order that executes itself automatically when the price of whatever rises to a level that you have set prior to that event occurring. And it's very good for entry into long trend following strategies, and the opposite of this is the sell on stop order, and again that would be for people looking to go short or sell the market, again for maybe a longer term trend following strategy approach. Back to the rules, he also noticed that the price can fall back quickly after a upper box penetration, so he wanted to add in some sort of safety net. So if he was wrong, he wasn't going to lose a lot of money. He realised that there was no sure thing, and that part of his problem in the past was that he couldn't lose properly. He had too much of an ego into the whole mix, wasn't impartial, and took too many chances. So he had to negate some of those problems. He had to reduce the risks at all times. Now, how did he go about doing this? Well, some of you have probably already guessed it, and it's more commonplace today for today's trader and investor. He built in a stop loss rule. Therefore, if the price reversed, he was out quickly at a small loss. And he also made the point that he could always buy back in because of this. And some further assumptions that he made, and this is useful for you when you're looking at creating your own strategy. He's started from a 50-50 winners-losers point, and that he has to develop his risk reward. Profits have to be greater than losses, and he must be very disciplined. And how did he create that discipline? Well, the discipline was really created around having rules. So, profits had to be greater than losses. He had to use trailing stop approach that kept him in the trade, so that stopped him tinkering around. Had he made enough? Had he, is he getting out at the right time? He was going to let those profits run, and he was going to sell when that hit his trailing stop. So he created an automatic, systematic process that took out a lot of the psychology and created its own discipline. Well, this is the rule that really does save you money. It's an essential trade management tool, and it is a process that stops you out of a trade either at a loss or profit. It's automatic, and you put those orders in predefined when you go into your trade, and you can often adjust these throughout the life of the trade. And if the market moves against you, you're wrong in your idea, you'll get taken out. It's a safety net. There are various types of stops to use, but it is a great weapon to protect your trading, and my advice is always use stops. It's one of the first rules I was ever taught when trading. Let's briefly analyse what a trailing stop is, because we've mentioned that a few times already. Basically what you're doing is you start with your initial stop, and then what you're doing, you're stalking, you're following, trailing the price as it moves higher. So as you move into profit, you're bringing up that stop. So then if it does suddenly jump and go wrong from there, you're going to get taken out and you're going to lock in some money. That's its aim, and it stops you also from tinkering around with the trade. If you have a defined process here, it is very effective at keeping you in that trade longer and therefore giving you a better return. There's many ways of creating the trailing stop: moving averages, pivots, Fibonacci lines, parabolic S&R, ATRs, manual support and resistance, and trend lines. We'll have a look at a few of those later in this course. So at this stage, if we drew a summary, paint a picture of what we learned so far, well, the strategy objectives of Darvas were to find the right stock, get the right timing for the entry on that stock, keep those losses small, make the profits big. And what tools did he have to do that? We had price and volume, his idea on box theory, and these orders that we've looked at, the buy orders and the stop loss sell orders. And another important rule here is that as that trend continued, those boxes built up, because he was trailing in a certain way, he wasn't closing out of positions, he was building up the size of his positions to be bigger and bigger and take advantage of those moves. So that's a very important concept to take away, in that the idea of building up a position. And also when the price reversed because of his rules, he instantly got out, and like he would say, he ran like a thief. Also, please note that in the 50s, trading was difficult for the retail investor, so his strategy was purely long buy only. So he was quite limited on what he could do compared to what we could do today. He was stuck in stocks. We could move to any type of asset type, and we can also go short. So bear that in mind when you're building your strategies. What I hope you've noticed is that he underwent and fought through a huge amount of psychological aspects to build up his strategy, but he also summarized them himself, and that he recognized that he had to be cold and unemotional, not to fall in love with that stock and trade. Learn how to lose, don't get angry when you lost, analyze it, work out why. There's no such thing as a good or bad stock, only rising and falling stocks. He had to hold the risers and sell the fallers, so again learning to lose well and bring those emotions under control, the fear and the greed. And he knows that all of this required massive self-discipline. So this whole process that we're looking at is, like I say, a great overview of how to deal with your own personal psychological issues within the world of trading. So he goes live with his strategy, and what happens? Well, it doesn't go too well. He's travelling the world. He realises there's a lot of costs inside the world of trading. He was out of touch with what was going on, and when he put skin in the game, i.e. his own money on the table, he found that his results suffered badly. So he had to keep training those emotions. And how did he do this? Well, he started with what he called a causal error table, what we would know as like a trading log or results table, where he jotted down everything he did, the performance analysis, how he got in, out, how he was feeling at the time, the reasons for those trades, and that helped him put together a picture of what was going on. And he also trained that assumption that stocks behave just like people. You can have jumpy stocks, calm stocks, nervous stocks, easy to predict stocks, etc., etc. So there's a lot of psychology and discipline and consistency and control that he's trying to build in and manage to make this strategy work. His idea, the underlying box theory, great, but he's finding that psychologically it's very difficult to apply. So the next set of results came in, and he was starting now to break even, and he found, though, he was getting stopped out very quickly, and he didn't know why this was happening, but really it was just the timing of when he started his strategy. He was right in the middle of a bear market. So actually, as he found that his theory and using the stop loss rule was actually saving him a fortune. This was 1957, so he was then confident that what he was doing was working, and he realised that he had to be patient and not to fight the crowd. And from all of this, he decided that actually the strongest approach for him was a blend between being a technical analyst and a fundamental analyst. What he was experiencing was typical for us today. Now I'll put that together in this sort of chart that we're looking at now. On the left, the start of your journey. To the right, when you're a master of trading. And I've also done it because I like my martial arts in different belt colours, so you can understand sort of level of competence you get through each cycle. And notice the steep learning curve, the red line to start with, and how that still keeps growing throughout time, even as you become a master. But notice the green profitability line. Phase 1, novice, rookie, you're all over the place really. And then you're learning how to create money learn how to build that money. So we've moved from cycle 1 to cycle 2, but notice how that line then smooths out and then moves past break even. So this is where Darvas really is at the moment, the end of cycle 2. Then when you move to cycle 3, you're starting to make consistent, regular profits, and you're making a success of trading. So there's a simple visualization of where Darvas is, and probably typically you and me are in the world of trading. We can use this as a good visualization for that. So on top of his technical analysis, his fundamental analysis theory was that he was looking for improving earnings, or the anticipation of, and he was also looking to future think what was going on. Where was the world going to be over the next 20 years? What are going to be the hot sectors and industries to get involved with? And he would only trade these new front runners. And in the 50s, the age of the jet aeroplane was coming to the fore, so he called this period the jet age, whereas maybe we'd now call it the technology, internet, social media age. Who knows? But like I said, he wanted there to future think. So two fundamental theories there: one earnings, the other future think. So what happened next? Well, his psychology overtook him again. He wasn't controlling his ego. He moved into a broker's office in Wall Street so he could feel the pulse of the markets. He lost his skill and control after a good start and was starting to lose, and he was blaming everyone else but himself. And he wasn't that lone wolf that he was, travelling the world, dancing and focusing just on his trading, but he was part of that herd of sheep. So in conclusion, he decided to continue his dancing, stay away from Wall Street, trade on that very disciplined information gathering process that he put together, and essentially build an iron fence around his trading. Well, the results of this, the results are legendary. He turned his $10,000 to a cool $2 million within 18 months, and I've converted that into 2020 money. So he basically started with $100,000 and he ended up with $19.5 million within a year and a half. That's pretty good going for a retail trader trading US stocks. Well, what can't we learn? Well, it's really the perfect exercise in how to succeed in trading. And new traders, losing traders, whoever you are, think that trading's very easy. It's all about just finding the one golden ticket strategy: buy low, sell high, etc. Anyone can do it, and you just have to solve a simple equation. But it's not like that, and Darvas found that out the hard way. He's written it all down for us, explained it all, and we can use his methods and ideas and theories, not just the box theory, but all the psychological risk management stuff around this strategy, all very useful to our world of trading. I think you've seen by now that trading psychology is one of the huge parts of this strategy, and one of the reasons for its success. And he learned how to lose, and lose in a disciplined, positive manner. That's very important, because a lot of people give up when they lose. A lot of people do silly things when they lose in their trading. So he learned how to do it in a disciplined approach, and he did that through his performance analysis, his tables, and working out what won, what didn't, why he did badly, etc. He learnt you had to be yourself. Don't follow those tipsters and gossip men. You don't have a plan, you're going to lose. There's no golden ticket. He discovered firsthand the destructive human elements of trading, the ego, the overconfidence, the gossip, the gambling, luck, failure, revenge, whatever. He found it all. And finally he got to understand what fear and greed actually meant in relation to his trading and markets. I keep mentioning fear and greed. Well, what is it? Fear is the fear of losing out, making losses, the wrong decisions, failure, fear of impending trouble. And greed is that ego, that unfounded hope, the euphoria, the excitement, the ignorance, all of that around your trading. All of those are very destructive to your trading. So, example, you're in a trade making money and you want to make more profit. You hold on, then the market turns and now you're facing a loss because you hadn't got any discipline there. Or perhaps you let a good trade go because you're too afraid of losing money. You've got to create the discipline, follow your trading rules, the plan, strict money management rules. It's very easy for your emotions to take control and play a much bigger role in your trading than what it should, and it's going to really ultimately destroy your trading and harm your results. He understood that having just a good idea wasn't enough, and he had to understand the psychology element to trading and how the behaviour of the markets worked if he was ever going to be successful, and that he had to add discipline to his trading to make those results better, more consistent and measurable. And he had to train his emotions. He understood his strengths and weaknesses. He understood he had to be resilient, adaptable, patient, focused, prepared. He would make mistakes and it was going to be hard work. And he did all this, it sounds a lot, and he did all this through creating a structured plan trading approach. What he probably didn't realise he was doing, and we've got a category for that now, and that is being a smart thinker. And to be a successful trader, you don't need the PhD in astrophysics or mathematics to succeed. It's the smart thinker that will succeed. He practiced the art of common sense, planning, problem solving, thinking outside the box, and he kept it simple, the KISS method. He came up with a simple tool, a box, to provide the foundations of his strategy, and all this created that winning approach, and it took many iterations, many redevelopments, and he learned new approaches and skills along the way. So smart thinking and the ability to smart think is a crucial skill to have if you want to be a successful trader. He knew how to build a trading plan. It's like if you're running a business, you wouldn't go to your bank manager for a loan without any evidence and information on why you would succeed. It was the same for Darvas. He built his trading project like he was running his own business. He ran it at a macro and micro level, even down to the costs of the brokers. Everything was accounted and planned for. It was structured, defined, it had goals and objectives. And he analysed those results and performances that he obtained so he could see how to improve. And he was aware of the risks involved, and they were also managed out of the equation, also very important. Today we can do a lot of this through programming to get rid of the psychological elements of our trading, but you can still do it the manual way, and that was to create a structured, ruled and systematic approach to trading. And that's not just about getting into the trade, it's about the risk and trade management, the performance analysis. He built up that picture and methodology to create it as systematically as possible. That introduced discipline, it reduced error, things like the trailing stops, the buy stops, the sell stops, the cause of error table. All of this made his strategy more successful, and these are the sort of things you need to add into your trading as well. If we're keeping it really simple, then we could summarize Darvas's success down to 3 areas. One was knowledge, second education, and the third getting that experience under his belt, the live trading, the analysis of those results to become a success. Let's really break those rules down now so that we can more easily apply it into our world today. So the first rule was that stocks were making a new 52-week high. When the high was set, then there are 3 consecutive days less than the high, because now we've got our peak. We're starting to create the top of the box, so that new high becomes the top of the box, and the breakout point leading to the new high becomes the low of the box. And you would buy the break of the box immediately. Remember using the buy stop orders so you don't miss out on the trade. We always had a stop loss in place, and that was placed just the other side of that entry line, the top of the box, or more conservatively below that box, and you add to the position as it moves higher, and we do that by trailing the stop, which we will look at shortly and how to do that in reality. It's got to be remembered that Darvas's rules were created back in the 1950s when charts were drawn by hand. They were still actually drawn by hand even up into the 90s. But now we've got technology and charting packages that allow us to do so much more on top of what Darvas could originally do. The levels of practicality that we have today far outweigh the 1950s, and we can enhance the original ideas, which we'll look at in section 3, and a lot more detail, and create derivatives around the original Darvas strategy. And you've got to remember that his strategy was long-term, long-only US stock positions, and we're going to see how we can adapt that differently into new time frames, new markets, commodities, forex, etc., and how to go short, which he couldn't do using the Darvas method. So these are 10 bullet points, not exhaustive 10 bullet points, but these are 10 points that I want you to take away and remember and try to build into your trading. If it's not the Darvas method, any form of your trading. Firstly, successful trading strategies don't have to be complex. They can be built around common sense, what you know, and you've got to make them as systematic as possible and follow a disciplined approach as possible to allow for consistent results. Learn the rules of the game and how it operates. You don't have to be a professional trader to succeed in this field. Be yourself and be original. There is no one type of successful trader. And quite importantly, learn to lose and lose well. It's part of trading. It's unusual and very strange to human nature to say you have to lose, but if you can master that in trading, you can become very successful. I think it's obvious that you've got to understand and master trading psychology if you want to succeed. Even as a high frequency or programmed style trader, you can still bring in psychology to the programming and the results and how that trades. So it's important for everyone to know and understand. Always use risk and trade management rules in your trading. Be that smart thinker. Think outside the box if you want to get that elusive trading edge. Always conduct performance analysis on your trading. Know your risk return. Let those profits run. Cut those losers short, etc. And always have a trading plan. Treat your trading like you would running a business. Welcome to section 3. We're now going to have a look at how we can use the Darvas Box method today, and in this section more specifically finding stocks the Darvas way, with a slight twist and modernisation to the approach. But we're now going to see how applying a systematic approach can find us those potential hot stocks that we're looking for. So let's remember how he found those US stocks. His filter was future thinking, sectors, up to 20 years onwards, where would the world be? Earnings growth and expectations, and is there any interest in those stocks? As we know, there's thousands of stocks in the US and there's tens of thousands throughout the world. How can we narrow it down to just a handful of potential hot stocks that are going to be winning trades for us? Darvas was only looking for long trades, i.e. when the market goes up, he's going to take advantage of that price movement. But remember, it's much more easy for us to go short. If we're trading CFDs, spread betting, whatever, using options, we can take advantage of the market going down. Now, going long and short, or especially short, can often confuse new traders, so I'm going to just spend a few moments explaining the idea. But basically we're selling before we're buying, and the mechanics of the whole way of doing so is quite complicated, but as a retail trader, private investor, you don't really need to know that. All you need to know is that you can actually go short. So not all financial instruments are going to let you go short in the retail trading world, but if you can, then going short will double up the trading options, and we can short using spread betting, CFDs, futures and options, and on some stock accounts. So there are a lot of options out there for you to take advantage of markets falling. So just two very quick examples of going long and short. So the top one, going long, you buy at 60, your anticipation is the market's going to go up, and then as time goes on it moves up to 100 where you think it's reached its top. You close the trade and you've made 40 of profit. Now at that point where it's at 100, you think, well, it can't really go that far. The only way the price can go is down. We can then sell there at 100 before we buy it, and then over the next few weeks the price comes back to 60 where we can buy back at, and that means we then close the trade because we don't think it can go any lower again for whatever reason. We then net 40 points of profit again. So very simple, going long, going short, doubling those trading options. So stage one of our approach to finding these stocks is the fundamental approach, and as we know, we want to narrow those down to a very small bunch of trades, and we can flip our analysis over. So whatever we do to find long trades, we could do the reverse to find short trades. You don't need to do this just on US stocks. Any stock market around the world this can work on. And we can now follow Darvas's guidelines exactly if we want to find stocks, or we can create our own deviations and derivatives to create short lists based on maybe our own assumptions and ideas. So this again is not an exhaustive list for you, but some thoughts and ideas that you could use to apply into your trading. So here are some filtering ideas, and some of them are very simplistic but could be very effective. You might pick stocks that you just want to follow because you have an interest in them, and maybe you want to follow a particular sector that you believe is hot or cold, like oil and gas or computing. You may have certain expertise from the profession you do in a certain field and focusing on there because your knowledge is maybe far greater than you realise, and focusing on that. You might have a hunch about maybe technology stocks that the original founder will outperform when you track these and trade them technically. You may want to just look at liquid stocks in the US, or maybe even make a career out of trading the FANGs, Facebook, Apple, Amazon, Netflix, Google. Or you could use something like options analysis for spotting unusual activity, or if you want to get really high tech, which I haven't written down there, and what a lot of the hedge funds are doing at the moment, you could use something like Google Trends, Twitter Trends, search engines to find what people are talking about and have an interest in. So what we don't want is a stock not going anywhere, a stale stock. Darvas was always looking for momentum, a reason for this stock to move, and because of the number of stocks out there, we haven't got the time physically to go through everything and analyse. And although future thinking can narrow it down, it won't narrow it down quick enough for us. So there are many free and paid scanning tools out there that you could look at to help speed up this process. I'm going to use one from Bar Charts for the example purposes here, and link to that in section 5. And also I use something called Stockopedia, but I'm going to use Bar Charts, I say, for this example. There's a lot of free stuff out there like Yahoo Finance, Google, that can also provide you some basic filters, and also your broker often in the software that they provide also have such filters. But for our purpose, we want to analyze earnings, and we want to do that very quickly. You don't have to do it on earnings. You might have another set of variables, but you need that software that's going to allow you to very quickly pull together, you know, a short list of trades for you. And again, it depends on the time scale that you're trading in. If you want a longer term perspective, just running these sort of approaches at the end of the day for 10-15 minutes, create a list would be very useful. If you're doing something faster, maybe you run these scans more regularly. So let's do some future think first to bring down the number of stocks we can look at. We can also plug in this future think into these scanning engines as well. So what do we think is going to be hot in the years to come? What reasons, you know, are going to make that stock move? What's trendy right now? You know, what's that catalyst that we're looking for? You know, for example, technology stocks, electric car companies, AI, biotech could all be very positive. Oil companies, have they had their day? Do you want to look at them for a short list? You know, draw up that sector list and, you know, specific trade list, and like I said, you can either just run it from that, or you can add it into maybe a filtering engine. At this point, the decision's yours. Maybe you want to stop at the future think. You like technology stocks, you like the FANGs, and that's all you're going to concentrate on. But we're going to try and stick more to the Darvas method. So from there, we need to move on to the second part of his analysis, which is finding good historical future earnings through a filtering process. So how we're going to do that, I said, well, we're going to look at bar charts, and I'm just going to pull up a very quick example for you now. Now here we have bar charts. It's a web-based application, covers all sorts of markets. It's a paid for monthly subscription service, very good value. It's got a lot of stuff you can do in there, and it also got, as we can see, stocks that we're looking for, and it's got its own screener. So I've built my own filter, and you can build your own based off lots of different variables to create a shortlist. Now the rules that you use to create the shortlist are up to you, but I've put together one here to filter out a lot of stocks, and we'll just take you through some of the variables I've used. And I've put in more than what Darvas would, because I want to narrow it down further, and he wouldn't have been able to do this sort of analysis. For example, I've put 20, 50, 200 day moving average in. I've got index groups, I've got sectors, price movements, and then we've got earnings surprise and 5-year earnings growth versus previous year, previous quarter, market capital, volume, average volume, because, you know, Darvas looked at that as well, highs and lows that the current stock have been pushing, and how far it is from its high and low. So that's my filter. But again, you can build what you like, but, you know, this is a very simple earnings bit of tool, and there are a lot more sophisticated ones out there, but this is sufficient for my purposes, and also sort of giving you the illustration of how you can sort of put this sort of stuff together. So let me take you through the filters here. I've set this up for a long scan, so I'm looking for today's price to be higher than the 20, 50 and 200 moving averages. Earnings growth high, 20 to 30%, and versus previous year and quarter 20% as well. They're just arbitrary. Just to bring up an example here, market cap, I'm looking for large, very large stocks. Volume, I'm filtering on volume. I want it to be medium high volume companies, and also the average volumes I want to be less than today's latest volume, because I'm also looking for those spikes in the volume that Darvas was looking for. So then all we have to do is hit the results button and see what we get. And when we do that, we just get 3 stocks pulled back: Autodesk, JD.com and SVB Financial. They met our criteria. We can then add them into our analysis. Now, our future thing might be that we're interested in computer and software and internet commerce companies. we might then just take those two and drop the banking company there. So up to you again. You might just, get rid of the future thing and apply the stock screener. Totally up to you, but I'm going to try and stick to as much as Darvas ways as possible. So that's one example of how to filter out stocks, and again, change the rules for the downside. I say up to you. So the final piece of the fundamental jigsaw is to find stocks that have some sort of momentum or interest behind them. What are the trendy stocks of the day? What is there that's going to give them that kickstart that we need to move the way we want them to? And how would Darvas do that? Well, he used volume. That's all he had available to him at the time. So you could compare current volume versus historic volume, or current volatility versus historic volatility. You could use options analysis to find unusual activity, or you could maybe even, which is becoming more popular with the hedge funds, use Google trend analysis, Twitter analysis, where you're scanning for those hot stocks, those ones being talked about, those ones with potential moves coming up that are going to move the price of the stock that we want to trade. So let's have a look at some examples. My first scan here for momentum is actually back with bar charts, and this time I'm going to be using options. But before going on to that, you don't have to make these scans complex or hard. Like I said, there's lots of tools out there that are free that can do this sort of analysis. You might just want volume, for example. Like I said, you don't have to do what I'm doing here. You can create your own smart thinking processes, but for here I just wanted to show you how you could use unusual options activity to narrow down some potential trades. And again, I've created a filter under the options section, and we'll take a look now. Now this screen here is very simple, and it can also be downloaded into Excel, where I can perform further filtering on top of that. Now I'll go through some of the variables here. We've got the symbol, the stock ticker, its name, the price, and here I've got an important factor, days to expiration. If I want to be more short-term trading, I don't want options that have got interest in moving a lot over 4 or 5 months. I might want the next few weeks, so I've actually stuck in 15 days here. I'm only interested in options that are expiring with a reasonable move in less than 15 days. You could pick your sectors. I'm looking at both puts and calls, again big companies, and this is another important factor I've got in here, volume to open interest ratio. I'm looking for medium to high moves, because the rule is if you see numbers greater than this, that's signifying unusual activity based on that calculation. I'm looking at some historic volatility, other various options inputs around price. I want large volume, there's reasonable open interest, and also, if you know about your options, I'm looking for out of the money options. And again, this is a filter for long trades at the moment, and that hopefully would give us that. So then we can produce a table. Now this filter isn't as succinct as the one we looked at in stocks on bar chart, so like I say, it's going to produce me a table that I then go into Excel and then filter more thoroughly on. Even saying that, I've just pulled back from Futures Think computer and technology stocks, and we've only got 15 of them. Some quite interesting ones there. Zoom, Cisco, companies like that, AMD, all very interesting. And what we're looking for here is short-term expiry days. So know what's going to happen. We want calls, so we could go back and filter the calls to make it an even narrower list. Let's just do that. Now it's gone down to 9, and then what I'm looking for is that there's potential upside of a decent price move to make the trade worthwhile. Now this does require some knowledge of options to get the basics behind it, and I'm not going to go into it here. I think I'm probably going to produce a course on just this unusual options activity searching, because it is very effective in giving you an edge in your trading. But basically, if you can filter here, we've got the calls, because that means we think the market is going up. People who want to buy these are going up. Normally these options traders are experts in what they do, so normally get things right. There's lots of liquidity in the companies, and from that I would then just go down the list, and for example Nvidia here, current price 538, and this option, call option, has a strike price of 680, so some way off, and it's got 7 days to do that in. So that might interest me to add to my list, especially knowing that it's computers and technology. It's one of those hot stocks, trendy stocks at the moment. It's worth maybe putting onto the list. So that is another simple way of using a filter and a different angle rather than just looking at pure stock data to get that momentum, that catalyst for why your trade should move. So here's another example, and we've gone to the world of Yahoo Finance, so we can show that we can do decent analysis that's not going to cost us anything, and it does have its own stock screener function, and you can play around with the variables as much as you like to create your own view on pulling back that momentum, that interest in stocks that we're looking for. And you can build up a great filter just using this Yahoo Finance. You've got earnings consistency, different types of earnings information, loads of share statistics. You can put on balance sheet, income, even insights and valuation methods to add to your filter. You could just do earnings consistency, you add that in, and you could then maybe just go for large cap and mega cap stocks. You might just want technology, and you can even drill down maybe just semiconductors, computer hardware, software. They were on your future think list, and maybe you want the earnings consistency to be high. Then run the filter and it comes up with your shortlist. Add that into the other factors to bring the ultimate list together. The future think, the earnings, the momentum, the catalyst for the change, and then we've got our really strong fundamental list of stocks to take forwards. One final idea for you here, and it's a bit more of a current one, is using something like Google Trends. Hedge funds, those type of players, are more and more using this type of scanning analysis, on Twitter, Facebook, Google searches, to pull back information that is highlighting to them what stocks are likely to move, what people are talking about. This is that Darvas extra momentum gauge, and I'm not going to go into the details of Google Trends because that's a science into itself, but to show you a quick example, you could maybe search in the new the new search item there, maybe hot stocks. So you could type in hot stocks and search term. We can see how that's trended over time over the last 12 months. You could change it maybe, if you're shorter term trade, to the last 7 days. We can scroll down and we can see what people have been talking about. And we've got Pfizer's because of the coronavirus vaccine. We've got Teladoc Health. we got Amazon, we got Royal Caribbean, we got Venkies. So, you know, and there's other topics you can drill down into as well, seeing what's being talked about. You know, there's Boeing Aerospace, Moderna. All of a sudden, just by typing in hot stocks, you've got a short list of trades that are popular and current at the moment, and you can filter by region, and you know, from there, and like I say, you can do by different category. We can focus in even more. We could maybe just do it on finance and see what they're saying. And again, we've got Pfizer's, Teladoc, you know, Cineplex, you know, and again further topics within that, and then we can click on them for more information if you want. So there you go, there's another example for finding the momentum, the catalyst for the move. So we've now created an approach to finding stocks of interest, but my tip here is to try and formalize and systematize this process as much as possible, make it automatic and build it into your trading plan. Otherwise you're going to find you just add stocks on a whim to your list, and you're going to probably end up losing because of that. So make sure they fit your criteria and don't deviate. So now we're going to move on to the second stage of the Darvas process, which is the technician phase. So the second part of Darvas approach was to add in the technician phase, i.e. as we know, technical analysis, and his tool is essentially a breakout trend continuation tool, and you can find it in most charting packages, including MT4 as an add-on. I'm going to use TradingView as the example here, as that's the one I use regularly and is probably most available to you guys out there. And if you're wondering how to get TradingView, we'll talk about that in section 5. But let's have a look at some charts now. First of all, we're going to need to find our Darvas technical analysis tool within whatever charting package we are going to use. And like I said, I'm using TradingView here, and maybe from my future think and my analysis, I like the stock NIO. Now NIO are a Chinese electric car maker, and as you can see over the last 6 months plus, their price has just been rocketing up. So the fundamental filter might get us to the NIO stock phase, but now we need to apply the technical filters to know how to time our way into such a trade. So I'm just going to show you here how you can find Darvas on the TradingView charting package. It's not a standard technical tool, as we starting to appreciate. Darvas is quite unknown, but a lot of you call them proprietary tools within TradingView have been constructed, and we can use those to provide us the indicators that we want. Now, how do we go about doing that? So we go to the indicators box, and we simply would run a search on Darvas. So we type in Darvas, and as we can see, actually there are a lot of different Darvas creations, and I've starred 2 here that could be of interest if you're using TradingView. One by this guy, one by that guy. Darvas Box buy sell, and Darvas Box with that lot after it. You can see the number of people who are using that through the system, but there are others that you might want to try, and there's strategies around that have already been created. Ones with a lock sign are there, I believe, to pay for, but these are the 2 I'm going to concentrate on now through our example. So I've starred them, so that adds them to my favourite list so I can find them more easily going forwards. So I've added in the Darvas Box buy sell, as you can see in the top left hand corner there, and through the colours that you can see on the charts. Now Darvas used to draw boxes, rectangles on his charts, and a lot of the software here sort of joins those boxes together, but we can see the boxes more clearly if I draw them on for you. Now I've tidied things up a little bit. I've changed those quite bright colours back to white to give us our lines, but I've also added in the boxes to make it easier for you to see. But fortunately with this tool as well, also tells us when the rules are met technically, so we get our buys and we get our sells, and Neo here would have been in a long trade because of our fundamental view, so we would have ignored all these sells, and when we get the buy signal, we instantly go into the trade. So we got one there, we got one there, we got one there, we've got one there, and we've got one there, and all of these have different results to them, the last one being very profitable, some less so, but there are rules about how we trade by using these boxes. So we know that we have our stop loss under there when we go into the trade, and the same would be here, under there, and then under there, and under there. That's a more conservative approach. Remember, Darvas sometimes put his just inside the box, which here wouldn't be too bad an approach. And then also we use these boxes to trail up when we're going to look at trading stops in a later part of the course, but quickly, we don't just close out, we bring it up and we build up these blocks as time goes by until we get taken out naturally. So here we'd have probably got taken out for a small profit. Here we go in, but we stay in because we trail up the stop, and we might have got taken out here where we could have left it in and got taken out there. If not, we're still in with 1 unit. We had another 2 units, we trail it up, we get another buy 3 units. Here we wait till that box establishes, it goes through, then we bring up the stop. We could have 4 units of Neo stop building up as time goes on. So this is how you can use the tool technically, and it doesn't just stop there. We can go back to our indicators and we can create different lengths of Darvas box as well. So I've loaded on another one. I'm going to change the variables. I'm going to make it a slower box. Let's take it down to 20. This Darvas never could do this sort of thing. Let's hide the first one, and I've left the boxes on from the other one, but so you can sort of see where we were at. But again, we've got a buy here that goes all the way up there, a buy here that just keeps on going. So you've got 2 trades there, and again, this is a system that you're going to have to be very psychologically tolerant with, because there's movements back against you. You've got to be patient with it. Put our stops here, trail the stops up, build up the positions. What happens when you get a big move back like this? You've got to stay with it until the rules tell you not to, and that is why we enhance, as we'll see with other indicators, because I want to take even more of that psychological element out of the trade. But you can see how you can adjust the inputs. You can make them faster, slower, down. You can take it down to the 3. That gives you even more than that previous one we looked at. Maybe too many. Maybe that gives you too many whipsaw trades, ins and outs. Play around with the variables. Again, up to you. I like the 5. And maybe long term, a 10 or a 20, and that's changing the inputs to be in your favour. Now this was for a typical long trade, but again, the reverse is true for a short trade. As the price breaks down through this red line here, it's a sell, but again, only because the fundamental reasons behind that tell us to go into that trade. So the fundamentals plus the Darvas box, then we've got our trade. So that's a brief overview of how you can find Darvas on a charting package. They're available, Darvas wide pretty much everywhere. I said on MT4 or other platforms. Dig around, find them. If you can't find the one and you need TradingView, then we cover off how to get trading view in section 5 of the course. Now, on its own, and with the addition of the fundamental stock filter analysis process that we've looked at, it's a very good tool, but it can be prone to problems and issues, and we want to take those issues away, and we can make this approach even stronger by adding in combinations of other indicators, or even using different types of chart, and to improve our odds of winning and reducing the risks, just like Darvas did back in the 50s. So we're now going to take a look at enhancing the Darvas Box tool. So by adding indicators, we're going to enhance the power of the charts. But what indicators should we use? Well, your sport for choice, RSI, stochastics, DMI, MACD, Bollinger Bands, moving averages, volume. It's a bit of a head shake on what you actually use. But the first thing to bear in mind and always remember is the rule of collinearity in technical analysis. What is collinearity? Well, it's a very important rule that you've got to obey, but what does it mean? It basically means adding indicators together, put them on your charts that are produced from the same information. So they might all be produced from the closing price. That's no good really, because they're all going to give you the same answer. What we want are indicators that are based off different independent inputs. For example, it might be volume or volatility and closing price, all good combinations. And I just listed out some good combinations below, ADX and oscillator, moving average, MACD and stochastic, because they're based off different inputs, whereas RSI, MACD and rate of change all based off the closing price. It's no good. So when you're putting these indicators together, bear the rule of collinearity in mind. You want independent inputs all telling you when to buy or sell together. That's going to make the idea of your strategy a stronger one. So you're now asking, well, what does work best? Is there a best indicator out there to use? Well, there's no right answer to that, and there are a lot of variables behind that answer. It could be your trading style, objectives, timeframes, markets you're using, but to test whether they work or not, I like to use them generically across markets and time frames, and if they work across those different variables, then I find them more useful and powerful. Also gives me more opportunities to trade other markets than trying to specifically tailor in. And a lot also comes down to personal preference and what you want to use, and like I say, the objectives and time frames you're using. Stochastic is maybe better in a faster time frame or a trending sideways moving market, whereas MACD's moving averages may be better in trending longer term markets. So there's thousands of indicators out there, and I've only listed the ones here that I use and I found useful. You could back test them further, but trial and error is normally the way of learning in this process. So I'm going to give you a few tools as a starting point, and we're going to take a look at some of them now. So to get you started, I've put together this table of possible indicators you might want to use, broken down by different columns. So we've got a trend, momentum, volume, volatility, sentiment. All of those create different combinations that you can put together. So you could take one from the trend column and add it to the volume column. You might want to take one from the momentum and add it to the volatility column. You might want to do trend, momentum and volume. But picking one from each will give you that ideal setup of where you're trying to find combinations based off different inputs to give you the same answer. So use this table as a guide to get you going. And by the way, CP on the table means closing price. So I say hopefully this will give you a starter if you're confused on what indicators to put together. But I'm also going to go through a few of the ones that I use in a moment. So these are the indicators I'm going to look at. Trend lines and moving averages, DMI, that's the directional movement indicator, volume, MACD and the RSI, the relative strength indicator. Like I said, you can take your own, use what you like that you maybe prefer, but I'm just going to walk through a few of these as examples. I'm not going to go into the theory of each indicator. I'm just going to show you how you can apply them around the Darvas box indicator, and then how we can put combinations of them together. So here we have our NEO stock chart again, daily candlestick chart, and we have on that the Darvas box indicator. So our first tools that we're going to use are the trend lines and moving averages to help us enhance the power of the Darvas box tool. Now this is a really simple example. I've added on here with the light blue line a 200 period moving average. That's a long-term look at how the price averages out over that time. That's what its job is to do, to signify a trend for us. And we could use this as a simple filtering tool. So we take our fundamental analysis, we come up with the idea of trading NEO, and it's a long idea. We want to be taking advantage of the price going up. So if we see the stock price of NEO above the moving average, we're going to be happy to take those buy signals from the Darvas box tool. But if it was below, we would completely ignore those signals, and we can speed up and slow down the moving average to whatever variables we want. But that's just a very simple example of using a moving average to filter out the direction of the current price of whatever we're looking at. And I've also drawn on a couple of trend line pattern examples that you might want to use as well. So you can see the lines I've drawn on there, and they are encapsulating a period of consolidation. It sort of confirmed the Darvas box theory, and we can see on the first, the bigger one below, as the price breaks out above it, we get the buy signal and we probably jump in, whereas we have a buy signal inside it and we might ignore that because it's inside it. And the second smaller one, we have a period like a flag, a pennant of consolidation, and then a breakout above. So just using trend lines and moving averages, you can start to build a much stronger, more confident picture in what you're trading. Staying with NEO, we're now going to add the directional movement indicator, the DMI, a slightly enhanced one, and we're going to use this for a sort of a trend direction, maybe even a timing tool to enhance the Darvas box. So I've taken away the ADX line, and I didn't really want to know about what was happening with the trend. I wanted to look at how the DI plus and DI minus were performing. So if the green line's above the red, it's bullish, and vice versa. And it's pretty obvious on NEO that it's all pretty bullish. But again, what I do here very simply is, if the DMI is showing bullish and then I get a buy signal on the Darvas box, then I'm going to take it. It's as simple as that. Just another way of confirming the signal. So for my next example, all I've done is added volume onto the chart. I've left the DMI and the Darvas box as it was, and also on top of the volume chart I've added a sort of shaded moving average area, so you can see how the volume price breaks its average run, indicating, as Darvas was looking for, spikes in the volume in relation to the signals that he got from the Darvas box. And there are many indicators in volume, and that's a study in itself that you could use, but this is a simple interpretation. But again, you add it to the DMI, the Darvas box, maybe a moving average and filters, you're starting to get a strong picture, like we said, around that rule of collinearity, about building up independent parts to give us strength to our trading signals. Now in this example I've added the MACD, and that is a nice trend following type indicator, maybe better in the longer term. Someone might argue against that, but I think it's better in the longer term, and we're just looking for the green to cross above the red to be a bullish signal, and vice versa. You can also use the histogram part as well, as it flips from green to red and red to green over the zero line to give you those buys and sell signs. And again, we just use it in combination with our Darvas Box indicator. And as you can see on this daily chart, it doesn't work that badly at all, really. Maybe harder to use with a bit more whipsaws, but then on top of that we might have further indicators. So finally we're going to look at the RSI, the Relative Strength Index, one of my favourites, and here we see it in its just basic standard form. I'm going to make a few tweaks to it now. I'm going to speed up the RSI, and then I'm going to add a moving average to create a signal around it to aid our Darvas Box analysis. So here I've changed the RSI settings down from 14 to 7, and I've added on a 20 period moving average, and what I'm looking for here is for the break of the RSI over the moving average. So to the upside it's bullish and to the downside bearish, remembering that we're looking only for bullish trades on the NEO. So when those Darvas Box signals to buy come, we then look at the RSI. Does it equate? Does it say the same thing? Yes it does, we go in. If it doesn't, we ignore. Simple as that. Another way of enhancing the Darvas approach, and also a way of enhancing RSI. I've ignored the 70-30 rule that you might be more familiar with, taken that away, just put on a moving average and made it a lot faster. So there's another example for what you could potentially use. So let's conclude this section with putting combinations together. I'm just going to throw together 4 of the things we've looked at to show you potential combination around the Darvas Box. This combination setup is up to you. It can come down to personal preference, how you back test it, what results you get, what markets you're trading, the time frames you're trading in. But this is just to really give you an idea of how you can enhance the Darvas Box setup. So here's that combination put together, and what we would be looking for here is for things to basically add up. Does the MACD turn bullish at the same time as the volume spikes, as the same direction that the DMI gives us? At the same time we're getting a buy signal from the Darvas Box. And on top of that, we could draw trend line analysis on there as well. Do we get a breakout, a pattern around that same signal and combination of indicators? So there we go. That's putting together indicators and tools to enhance the Darvas Box. The combinations are up to you. I've given you some examples. Go and work and build on your own. And remember, we've now got the fundamental approach tied in with the technical approach, and this is where Darvas started to strengthen his returns and become more successful as a trader. So a brief recap on some of the rules re chart setup. Firstly, make it part of your plan so you can become more consistent and disciplined. Don't change the indicators around and have one randomly just because maybe you're losing for a period of time. You've got to commit to that setup. If it's not working, then review it. Ask yourself why. Can you come up with the answer to the problem? Create the solution and then deploy it. And if you can't backtest, maybe like programming, then assume like Darvas did that you start from a 50-50 point of view and build up the results, say over a period of time in a live environment. say maybe 1 month, record everything, what worked, what didn't, and use this information to improve. We've now got the basics of a chart set up, and Darvas's approach was to go long only, but we can now see how we could potentially go short as well as using just that long approach that he did. Now, critics of Darvas said that the short approach doesn't work that well, but that's not true in my experience. So long as you complete the same steps to your analysis that we've covered that are appropriate to markets that are falling, so you're going to look for maybe weak sectors, bad sectors in the fundamental side, what's the momentum behind that, and these stocks can trend very nicely for short or long periods of time in either direction. And also remember that Darvas traded on an end of day basis, and we know that we can now use different time frames across different markets. So we know that Darvas used a longer term end of day type of process, but can Darvas methodologies work in different time frames? And the simple answer is yes. From my experience, you could go longer term, weekly charts, so 4-hour charts, or down to the shorter term, 2-hour, 1 hour, 30 minute, 15 minute, 5 minute. The choice is yours. Really, any time frame, as long as you keep those rules of construction consistent, you've tested them, they work. Let's take a look at a few time frame examples. So it doesn't matter what time frame you're going to use, you've got to create a disciplined, consistent approach to finding out whether what you're trading is either going to be a long or a short trade. Now here we've got gold weekly chart. It's got a combination of buys and sells on there, but it's no good just taking all of those signals. We've got to filter them out. Is the trend more bullish or bearish, and then action on that. So we can do that by adding the indicators and or our fundamental process of analysis. Now, as we're going to see in a minute, other markets can be very different for commodities and say FX. Let's take a look at another example in a faster time frame. Now here we have CAD JPY, a currency pair. It's a 15-minute chart with the Darvas Box settings. Now I know on top of this that the actual period we're looking at, it was bearish, so in this instance I'd only be looking to take the sell signals, but you can see it clearly gives you opportunities in all sorts of time frames. So the next question I get asked a fair bit is, can Darvas work in other markets? And again, the simple answer is yes. Whether it's forex, commodities, stocks or indices, it definitely does work in those environments. And again, it comes back to building a consistent rule base around asset selection. Why is the commodity going to go up or down? What are the fundamentals behind it, and then what are the technicals behind it? You can use the same technical setup, but the fundamentals are going to be very different under there. Same for forex. Maybe something like a currency strength filter to aid your analysis is of better use to filter out what pairs are the strongest and the weakest. But like I say, build a systematic, consistent process if you're going to trade those other markets. Now the technician stage, like I've just mentioned, you'll probably find very similar across markets, and you can get it to work across markets with the same indicators and setup, which is nice because you can again create consistency. It's the fundamental part when you're trading these other assets which you're going to have to look at more closely. So here's an example using forex, and we're going to look in particular at finding the strongest and weakest pairs. This is a currency strength indicator you're looking at that was available on TradingView. I've tweaked it slightly to make it more clear to me, but nothing too spectacular in its changes. And as you can see on the right, you can see the currency pairs that it thinks at the moment are the strongest and the weakest, and we've got Japanese yen at the top, followed by pound. It's our top two, and our bottom two, Canadian dollar and US dollar. So if I was looking at the tops and the bottoms, I might pick the pound and the yen against the CAD and the US dollar. So let's pick any pair there. GBP against the USD. That's our fundamental reason. It's looking like the pound is getting much stronger against the US dollar. We might have some other economic or fundamental reason, but this is what I'm going to use to filter my trade. So we then move on to our setup. So within our pound versus dollar chart setup, it's a 15-minute chart. We've got our filter. We're saying the pound's strong, so we're looking for bullish signals, and all I've done here is apply a 200 moving average on the chart as a trend filter. So anything below we ignore, and anything above we look to buy. And we can see we had two opportunities to buy in late in the day. This is 1 day's trading time. We've missed the big move in 6 o'clock, but hey, we can't get everything in the trade. We're looking for consistency and discipline. And here we have a breakout, late afternoon and into the late evening. So same rules, same process, same entry. Build it up with other indicators if you want to. That's just an example of how you could take this stock idea of Darvas is into other markets. And it's the same with commodities. The COT report might show that everyone's bullish gold. Again, that's your fundamental into the trade, and then it might be a longer term trade perspective, daily, weekly chart. Then you build those indicators around it and trade accordingly. And going back to our original example from section 1, we looked at the NASDAQ 100 on a daily chart. It's a Heikin-Ashi chart, and we also had a modified DMI. We had a moving average on there and some Bollinger Bands, but we can see how beautifully that played out over the longer term, a much longer trade, how it built up over time. We've been using traditional candlestick charts so far. Heikin-Ashi smooths out the data there. We time the buy signals in with the moving average and the DMI, and also our fundamental analysis. However, we've concluded that NASDAQ 100 we think is positive. That might come from many fundamental areas. It might come even from, say, using volatility, and the VIX analysis is things looking calm. There's less fear in the market of the trends continuing. Whatever it is, make it consistent and disciplined and apply accordingly. But as you can see here, another market, indices, it works very well in. So let's take this all into the next section and put it together into one big comprehensive strategy and structure and approach. So let's start to put our strategy together. Firstly, we're going to have to decide what markets are going to trade. Tip here, don't try and trade everything. Create a plan around that. How does it fit into your trading objectives, lifestyles? How much time have you got? Maybe focus on a particular market. And as in 2, don't try all time frames either to trade in. Don't put yourself under unnecessary pressure. If you've got all day to do this, fine, but be realistic. And once you've decided on the markets you're going to trade, then you've got to construct stage 1, which is the fundamental plan. So in the fundamental plan, we're breaking it down into 3 parts. If it's stocks, don't forget the 3 steps: future thinking, earnings, interest. If it's other markets, detail out how you're going to filter these markets fundamentally. I've mentioned the COT report for commodities, currency strength tools for FX, and maybe VIX volatility for indices. And then the third point there, you've got to make the fundamental plan as systematic and consistent as possible. Really important. Then we move on to the technical part of the plan. and that first of all starts with agreeing the time frames you're going to look at. Stick with these, don't jump about just because something has caught your eye from outside your plan. If you do that, you're going to lose. We need consistency and discipline. You're going to need to finalise the technical tools and indicators you're going to use and put together. Don't forget that rule of collinearity. And to start with, I suggest just doing an eyeball test on what works. Look back over the charts, see if it just makes sense before committing into some hardcore back testing, and get all this written down onto your trading plan and commit to it. And then we move on to trade entry rules. Very simple, as Darvas said. As soon as that top box is broken for a long trade, we would then go in instantly, and we would use our stop orders to do so. The reverse should be true for short trades, and remember, this is also in combination with the fundamental analysis and any other technical analysis indicators that you are using. So with the entry, be as consistent as possible, otherwise you're defeating the purpose of the strategy. If you lay out the rules of entry, you've got to get in that way, because you need to be able to analyse this data and results afterwards. And don't forget to put in the stop loss orders, because those markets can move quickly. And you also have this ability, every broker should offer you the chance to put orders in on buy and sell on stop. If they don't, then it's probably not the broker you should be hanging around with. So another one of the hard things is knowing whether your strategy setup will actually work, and how do you go about testing your ideas. And you might not be fortunate enough to be a super programmer or have access to the data to be able to test as thoroughly as you'd like to find out whether you've got an edge. But don't worry, we can work off basic assumptions, and this is what Darvas actually did. He started from the point of view that everything was a 50-50 win-loss, and that he had a slight edge of just 1% over the market, so he knew that over the longer term he would make money. And if you adopt those principles to start with, what you then must do is keep very detailed analysis of your results to see if it's working or not, or whether things need adjusting, tweaking, fixing, or stopping altogether. So their performance analysis is crucial if you're going to go from this assumption basis for testing your strategy. It really is worth it spending some time trying to create an optimal Darvas setup around the inputs and the time. But the warning here is don't backfit your analysis to make it work. Try and make it work generically across different markets, timeframes, different stocks, whatever. And also ask yourself, the who, what, why, where, how, and when at all times. Why will your strategy and setup work? And initially, if you go live, and is a tip that I've used in even the professional world, and you're still unsure about your strategy, scale back the size of the risk that you're putting on every trade. Maybe just do half the size that you would do, but really you do need to test this with real money, because you'll learn a lot faster than just running it in the demo type of world. So if in doubt, scale back to as small as you can, but at least get some real live data under your belt. So what performance measures could you look at to see whether your strategy is working or not? Well, you could use things like win-loss ratio, Sharpe ratio, risk return, holding period, whether you've been long or short, what's your average win or loss, the drawdown that you have, number of trades you do, when you do them, and also the human elements in there. Were you feeling good at the time? What time of day? Were you affected by school runs? Etc. etc. All these sort of things go into the performance analysis, and I'm going to leave you to dig into those and construct the ones you want to use to be able to measure your success or not. And very importantly, and which is often overlooked, is add in risk and trade management rules. We're going to look into that in a bit more detail shortly, but if you don't add in these type of rules, you are going to lose, and lose very fast and badly. Getting into the trade's easy, but making that trade work, bringing it to the finish line by using trade and risk management rules is just as important to the successful outcome of your strategy. I like to visualize things, and this is a simple flow chart of a typical trading process. It starts with the research. You find the potential ideas based around our strategy. We create a short list of trades. We put in our orders. We develop the risk and trade management rules, portfolio sizing, risk limits, etc. We execute the trade. We then manage that trade through stuff like trading stops, and those trade management processes. We have a defined exit strategy. We either take a profit and loss, and from that we record our results. Then we analyze those results, and that process spins round and round and round like a washing machine until you come out with a more consistent approach. And this is what Darvas did. He tried and regurgitated and rethought and built up and up over time, over many iterations, until he came out with his successful winning strategy. So remember, final tip here, always have a trading plan and treat your trading plan like you were running your own business. We now go into in a bit more detail, have a look at how you can apply some risk and trade management processes to the Darvas Box methodology. And like I said in previous sections, risk and trade management crucial for your longer term success. So please don't ignore this section, take it on board and add it into your trading plan. So first, risk management. What is it? Well, it's keeping you safe. You're not going to jump out of a plane without a parachute. So risk management is about having a set of rules around your portfolio to keep the money in your bank, the shirt on your back, and like I say, to keep you safe. It's about how your trades fit into the portfolio and how much you're going to risk on one trade. Now I call that one trade 1R for purposes of this course, and I suggest that you risk between 1 and 5% of your total pot. That gives you either 100 to 20 goes of getting it wrong, and to get 100 wrong in a row is almost statistically impossible. There's other methods when you get more serious about your trading, more advanced stuff from gaming theory, for example Kelly's criterion and how to size up winning trades. But for now we're going to look at the fundamentals, and firstly I'd prefer you to be consistent and settle on a percentage and stick with that. Add that into your trading plan along with the other risk rules that we're going to look at. So to give you an example of the 1R, trading pot of 10,000 and you're risking 1%, 1R would equate to £100 of risk per trade. The 1R in the stop loss section will be the amount that you are therefore risking on that trade, and we divide that level into the risk amount to determine how much maybe pounds per point if you're spread betting, or lot size if you're using CFDs you're going to apply to that trade. But again, add this into your risk rules part of the trading plan. So moving on to trade management, this is about the micro management of your trade rather than the risk management, which is the macro look. Firstly, always use a stop. That's rule number 1 in trade management, and we're going to use our initial stop loss when we decide of the trade that we're going to go into, and this is going to be used for that safety net. If the trade goes wrong, we're going to get kicked out automatically. There's a lot less emotion to it. We're wrong, we're wrong. And how do we calculate that? Well, I call it that the difference between the initial stop loss price level and the trade entry price level, which equates to 1 unit of risk. And we can have multiples of this or fractions of this, and it's useful to define this in the trade management process. So I'm going to look at 3 ways here in this section: using Darvas, using Bollinger Bands, and using pivots. 3 simple ways to set that initial level. There's plenty more. That's not an exhaustive list. You may know other ones that you prefer to use, but I'm going to stick to what Darvas came up in his strategy and some other simple, easy, quick ones to apply. So Darvas used his initial stop process quite simply around his box methodology, and he did it in 2 ways. You could call them aggressive and conservative. The first one, and we're talking for long trades here, was to put the stop just below that level of entry in the box. So that's the more aggressive one, and the more conservative one was to drop it just below the bottom of the box. And normally as the trade progressed, he would add to his positions by 1R when the new box trade entry criteria was met. So he'd drag up that stop that came about from the initial setup as it went higher and higher, and with the advantage of making bigger returns in the long run. So let's take a look at how you could put the stop on a trade using the Darvas method. So we're looking at the Google daily Heikin-Ashi chart here, zoomed in for recent activity so we can more clearly see how to place our stop. And you can see on the right hand side we've got a buy signal through the Darvas Box setup. So where would we put our stops if we were Darvas? And for whatever reason, we're going to go long Google. We're not worried about the short trades. Our fundamental analysis told us to. And where do we place? So the aggressive method is just below the top of the box, and the conservative method is just below that low of that initial box. So I've highlighted in the box there to make it more obvious which one we're talking about, but really it is that simple a trade management process for setting the stops. Not much to it. In his theory is, well, if it goes wrong, but the theory is it's going to still go up Google, then he's going to buy back in and not mess around with waiting on the trade to turn around. It's quite a disciplined, aggressive approach. So yeah, that's the first method we're going to have a look at. Now the second method is to do with Bollinger Bands, and you can see the light bluish cyan coloured bands that are now placed over our same Google setup. And what I've done here is I've expanded the standard deviations, because Bollinger Bands are a measure of volatility, and you can change the variables as much as you like. I've looked at a longer look back period, more so than the 20 that its standard setting is. I think I might put 50 in here, and I've widened the standard deviations out to 2.33, which is 99% of price activity should be within the band, so you'd be pretty safe to put your stop around those levels. It makes it a bit wider in this approach, but again you can make it tighter, more aggressive if you want. Again, it's just an example to show you how you could use something very quickly and simply, another indicator to come up with a safe stop loss level. Now our final idea is using pivot points, and they are very popular in the world of FX, but they're very similar, I suppose, in application to the Fibonacci lines, is that they act like magnets towards the price, and they're very good at creating support and resistance levels. Now on here I've just added on monthly classic pivot levels, and we could just simply place our stop loss under the next lowest pivot line for a long trade, or we want to go more conservative, we could drop down to the next one after that. But again, just another simple quick way of coming up with a stop loss methodology. And what about the trailing stop idea that Darvas applied? Well, when he came up with his trade idea, he didn't have a upside target as such. He used to trail these stops until he got taken out naturally. So how did he do this? Well, he did it again using the boxes. one of the key reasons that he made so much money in his strategy was this trailing stop approach. It allowed him to grow the trades, and he did expect, to lose some of the top edge of any trade because of the pullback to the stop. Now, depending on what approach he was taking, conservative or aggressive, that swing's going to be bigger or smaller. But going back to our original NASDAQ example, and now what we know about how he placed his stops, either just below or underneath the box, what did he actually do in terms of the trailing stop? Well, what he did do was he waited till the next box was established before then moving up his stop to that next lower box level. So in our example here, which is an obvious one using the NASDAQ 100, which really trended up over that period, and again this strategy of trailing the stop really does work well in a nice trending market, not so much in a flatter market, so you have to be a bit more cautious with the approach and how you're going to get in and out of the trade. And I think in today's modern world of trading it's harder to perform this, so I might add on other rules around it, for example with indicators on top or the way the price moves back into the box, etc. But for this example we can take a quick look and see how, just by looking at the arrows there, how it moves up and up and up. And if he was underneath the bottom of those boxes all the time, he'd have made an absolute fortune on the NASDAQ 100 as it moved up from the bottom box around about 9,000 all the way up to over 12,000, so 3,000 points within 6 months. That's a lot of money to be made, and stocks in particular will trend more like this than some other markets, so you just have to be aware of the markets you're trading and whether you need to adapt this approach slightly. But this is how he trailed the stops. You could write a book on trailing stops alone, but I'm just going to throw 3 other ideas out there that could be used on their own or in combination with Darvas's methodology, but as it says, they always make it whatever approach you take systematic and as consistent as possible. So 3 methods to look at here very quickly, alternatives to the Darvas Box stop methodology. Now this is sugar, number 11 on a daily chart, just to show you some other examples of other markets. And for whatever reason we're looking at buying sugar fundamentally, and back in October we saw a nice breakout. Where could we put our stops in terms of a trailing nature, that is? Well, we could firstly use a moving average, that light blue line. We could follow the price up behind there, then we get taken out on the red bar back in November. That's if we wanted to do it that way. We could maybe use Fibonacci, and where we get in October we might have our stop in one of those lower bands of the Fibonacci levels, and then we move it up by Fibonacci level as it progresses in price. Or we might even decide that once it reached a certain Fibonacci level we might even get out of the trade, but that defeats the idea of rolling the trade forward through the trend. And the other idea is a time based trailing stop, and that basically means that maybe you follow the price number of bars behind the current price. So it could be the last week, last 5 bars, the last 3 bars. It's totally up to you until you get taken out of the trend. Now if your theory's been right and the market is trending nicely, then that sort of approach will follow up very closely behind the price and should make you a good return. So there's 3 alternative concepts, but you could also build them into the Darvas Box idea. But again, whatever you do, make it a consistent, disciplined, structured, systematic approach. If you don't, you'll start picking and choosing different variables, different ways of getting in and out, and then those results will peter off they get inconsistent and you won't know how to measure your returns successfully. So many of the crucial parts of trading are missed out, and that is why so many people lose at trading. And this is another one, performance analysis. Every top sportsman or business professional or anyone with any success does this sort of thing, so you've got to do the same in trading. Darvas was constantly doing this and made it part of his trading plan. So we now got the strategy set up, we got the risk management in place, we got the trading plan laid out, and you've been trading away for months, and you don't know, you think you're winning, but are you winning well? Have you winning enough? What are you doing wrong? You don't know because you haven't been recording the results. And this is a big no. You must record everything you do. It's not over when you close out that trade, and it doesn't mean anything, all that trading, unless you can understand it and decode the results of your actions. Trading and investing is a results driven game, and knowing your own personal SWOT, strengths, weaknesses, opportunities and threats, will be crucial to your success. I was lucky in my professional career as a trader because I had teams of accountants, risk managers and management analysing my every move 24/7 and providing me with that data. As a retail trader, you're not so lucky, or if you work in a smaller organisation, you have to do that yourself. You are your own support network. Like I've said, how do you know if something you're doing, you're actually doing it well? You're trading something you shouldn't, taking too much risk or not enough, making the same silly mistakes. How do you optimize your performance? So like I said, that support network, you are not only the trader, you're the accountant, the risk person and your own boss. And from that, 2 things you're going to need to do if you want to succeed. The first one is to think like a top athlete would, and that is to adopt those type of practices. They don't sit on their laurels. They're constantly evaluating, re-evaluating, changing, evolving, processing data and information to get that slight edge to keep them at the top of their game. And that should be the same for you in your trading and investing. And this is where technical analysis can come in, because the technical analysis can create the data for us that we can start to analyse. And all that data that you collect, there's no use collecting bundles of useless data. You've got to action that data. So make results evaluation part of your trading plan. Keep that trader's log. That's very important. Record the detail of your trading activity. It's a simple quantitative process. It's not too mathematical, no science behind it, and it doesn't need to be too hard or time consuming. And like I said, the technical analysis and the commitment that you'll make will help create such a log. So say just once a week for half an hour, put those results down, go through it, but commit to that half an hour per week. So you ask, what sort of statistics could you pull from technical analysis, where you've got your entry price, your stop level, targets, exit points around every trade. You've created a risk and trade management process around the technical analysis. You're going to get risk reward levels, points risked, and so much more. And over time you're going to keep this history backdated, and you're going to use that as a library to access very effective, interesting information on how you've been winning and losing, those sort of ratios and numbers that by tweaking or working out what's going well, what's not, can make a seriously good impact to your trading results. And much like Darvas, he added extra comments onto his analysis. Why did he close out? What were the market conditions like? How was he feeling at the time of the trading? All are helpful in creating and finding that edge in your world of trading. And what could such inputs look like, and what could you include? It's a very subjective process. A A lot of it is also common sense, and a lot of it is out there for you to explore information wise, but here's a brief list for you. You've got pre-trade information such as the products traded. You know, you might be losing by just trading FX, and you might be winning every stock trade, but you won't know unless you record that. You know, the type of trading strategy you're applying, the trade date, maybe you're losing on certain days, you know, direction you're taking, maybe you've been better in the long than the shorts, what type of risk you're using per trade. Maybe you're risking too much in losing areas and not applying much in the winning area. You know, how many pounds per point or lot size are you using. Then we got entry trade details, you know, the trigger date, entry price, size of the trade, stop loss level, risk, and price information, entry, exit, stop, risk, reward, points risk, maximum loss, and closing trade details. Why did you get out, the time, date, the price, and the P&L. Darvas did all this in his own sort of way, and analysing your trading statistics helps take away a lot of that psychological issue of trading. If you're confident in what you're doing because of the numbers there behind you, and you know what to expect, it's going to create a very strong, powerful approach to your trading. You've done your SWOT analysis, you've created an engine of change and improvement, and that's what you need to do, constantly evolve to be a more successful trader. So we're going to finish off section 4 by looking at 3 very different approaches. The first one on US stocks, multi-time frame in a faster trading window. The second using commodities and a COP filter, and the third using a different type of chart altogether. We've looked at Heikin-Ashi and candlesticks so far. Here we're going to take a look at line break charts. So this is our first example, and it's US stocks, and we run our filter and we future thought, and surprisingly to some of you, General Motors has come up on my watch list, and that's because they have a big electric car interest, and they've actually been recovering quite nicely since August of this year into a nice solid bullish looking run. So on the right hand side we have a 4-hour setup with the Darvas box, and then on the left hand side we have a 30-minute Darvas box setup, and currently the trade isn't quite there. If we clear some space, you can see the price is working into this new box. Okay, so we wouldn't take a trade yet. Now what we're going to do here is, when we get the buy signal here, instead of trading the 4-hour, although you could if that was part of your plan, we take it over to the 30-minute and we wait for those trade signals to happen here. So we've got a breakout here, then we would buy. So if we just rolled that back a few weeks to the early part of November, we see we've got a buy signal here. I've got a DMI double indicator, faster and slower, both telling me it's green to go to the long side. Above these moving averages, the 50 and the 200. So the 4 hours looking very good. So that in itself could have been the trade, but I want to focus in and double up my efforts. So I could put that trade on, but I'm going to go over to the same period when the trade happened, because you can also bring in a tighter stop by using a faster time period. And here was that point on the 4-hour chart, and we had a buy signal and we were both again green to go on the DMI. I've put the pivot points on here so we can see them in relation to the box method. So we could put our stop just below here. The price breaks up, and then again what we would do is we could trail it up all the way as it rolled up, and we could use maybe the longer term 4-hour chart as our exit point from the shorter term, or we could use maybe these crosses or the DMI to get out. The options are yours, but this is a multi-time frame approach. So first of all, I did my fundamental analysis. I shortlisted a bunch of trades. General Motors was one of them. I want a lot of price action and potential trade action, so I take the analysis to a 4-hour chart instead of a daily to give me more signals, and then from there I take that even further down to a 30-minute chart and get more specific, and hopefully in any trading day take the options that present itself. So there's one method of trading using stocks. Now my second example here is using soybean futures. We're in the commodities world, and the commitment of traders index. Created this within TradingView. I'm using a modified DMI as I did in the stock example. Got my moving averages, the 50 and the 200. So we can see, also fundamentally I know soybeans are very bullish at this period of time, so I've got another overlay of my fundamentals apart from the COT index. This black line are large speculative traders and the red line are the commercials. Now they normally do the opposite to each other. If I see the black line going up, it's bullish, and if I see the red line going down, it's bullish. That's happening. It happened here around this buy opportunity. Exactly the same process. Then we're good to go. We put the trade on, we trail the stop, keep following it up, and it's up to us how we manage it on the way out. But there's a very good long-term bullish trade there on soybean futures. So that's using the COT index and an underlying knowledge of seasonality of the commodity to trade that market. And our final example, the final example is actually using a completely different chart that we haven't looked at. We've looked at Heikin-Ashi and candlestick charts mostly throughout this course, but this one is a line break chart, and I've got a course on this one as well for you interested. But I just wanted to throw this at you, that the Darvas Box theory doesn't just work on the standard charts, and you'd never be able to do this in Darvas's time, but this is a slower line break chart, a 5-period one. Trends very nicely, and the rule's exactly the same as it breaks out by, trail it up. I've got the Bollinger Bands on there where you could use a stop or an exit point, up to you. But just another example, Shopify, it was on my fundamental list, and it works also on a completely different chart type. So there you go, 3 different examples, something for you to think about and how to build your own strategies. Good successful trading is not just about taking a course, it is a journey, and because of that you need longer term support and content resource available to you to progress you through that journey, hopefully to a successful finishing line. Now at the Stop Hunter, I've put together all of that sort of stuff on our website, www.thestop-hunter.co.uk. So in this section we're just going to have a quick look at the website to see what is available to you. So welcome to the Stop Hunter website, and the first thing you'll notice is that we do cover off a lot of markets, stocks, and that's US, global, cryptocurrencies, all sorts of markets there, NFTs as well, forex, commodities, and stock market indices. So we cover a pretty broad spectrum for you there. Now scrolling down the home page, you'll notice 8 blocks, and they are the areas that we really cover in some depth. Now over on the right hand side we have fintech and consultancy services, so we go out to professional traders, institutions, schools, universities, and come up with trading, financial markets solutions, teaching programs for them there. So you can click on those blocks if you would like to find out more. Now we have our e-learning offering, and if you clicked on there it would take you through to the other courses that we provide at the Stop Hunter. And quite excitingly, the YouTube channel is one that we've been working on quite a bit over the last 6 months, and there's hundreds of videos and a lot of content there for you that will support your trading journey and your objectives in there. So I recommend that you go and take a look at that. Then we've got 4 other blocks that really get you into the nitty-gritty of whatever markets you want to trade. We've got Forex, stocks and options, cryptos and NFTs, and my bread and butter, the technical analysis area. So if you want to learn more about technical analysis, click on the link there and that will take you through to the relevant page. Once there's a lot to explore, and if we scroll down the page we can find out what's available to you. Simple questions and answers, why learn technical analysis, and those resources that I was talking to you about. There's free courses on YouTube, there's links to our e-learning, specifically the technical analysis courses, and how to access the YouTube channel. And more specifically, I get this asked quite a lot, what charting package should you use? So done a bit of an overview there of the reasons and ideas for selecting a charting package, and down the bottom there the charting package that I use in the courses in YouTube and in my own trading view, with links through to find out more on that platform. So if you want to learn more about the Forex market and what resources we've got for you there, then hit that blue block on the home page and then scroll down within that page and you'll find videos, reasons to trade Forex, Forex trading explained, a trader training course coming soon onto the YouTube channel, links again to the YouTube channel, a video on how to find a good Forex broker, top 10 tips, and then the brokers that we recommend to you to be trading Forex. Now we've got Trade Nation that are CFD spread better. We've got Forex.com if you're a US citizen wanting to trade the Forex markets. Then we've got City Index and Forex Box that are also CFDs and spread bet providers. So hit that yellowy gold block on the home page and it'll take you to the cryptos and NFT section. Now I'm hoping we've got you covered here. We've got loads of stuff on courses, Traders Club, which we'll talk about in a minute, upcoming content, and then the exchanges that I recommend and use myself. You can see, you click on those and it will take you through to them if you want to discover more about those. And trading bots, I'm heavily into the trading bots world. I'm going to produce some courses on that as well soon. But if you haven't got the programming skills and you want to get straight into automating your trading, then here's 5 possible recommendations for you to explore. Again, click on the blocks and it will take you through to them. And then to finish off, we've also got some stuff on securing your cryptocurrencies, hard wallets, and we recommend the use of Trezor in here, and there's some offers down there for you to follow as well. So hopefully we've got you pretty well sorted on the crypto NFT space. Then hitting the light green block on the home page is going to take you through to stocks and options, and again we've got a lot of course and extra free content here, how to learn to trade options, stock markets, the ins and outs of how they work, Traders Club again, and the stocks that we cover. There's a pretty good selection of countries there through the brokers that we use: US, UK, European stocks, Swedish, Norwegian, Finnish, Swiss, Canadian, South African. Like I said, plenty to choose from wherever you are in the world. And if you want to trade US markets directly, stocks and options, then we use First Trade, and they have international accounts which can allow you to trade those markets from other places around the world. Then we've got a couple of spread bet CFD providers that give you access into other markets around the world: Trade Nation and City Index, South African stocks, US, Scandinavian, Swiss, Canadian, those ones I mentioned before. Now if you want to find out more about them, click those visit links. They're all ones that I personally use and recommend. So that's the last of the sectors. Now I want to take you through to the Traders Club. So a recent development at Stop Hunter is the Traders Club. Now we've run Traders Clubs before in different guises, but this one is totally free to join on Discord. It's very easy to set up. You just go onto the block, click on the link and then follow through what Discord tells you to do. It's totally free, like I said, and it covers really everything. Analysis, research, exclusive content, education, offers, competitions, the whole lot, ideas. And I put some webinars and videos in there as well for you to follow. And I suppose one of the big plus points is it's a community and there's like-minded traders, all talking to one another. Share your thoughts, opinions, fears, ideas, all of that lot in this club. And I'm also on there pretty much all the time, so I will pipe in every now and again, do a bit of analysis, content, and I'm there to be asked questions. So it's a very good free resource for you to sign up for. So like I say, just click on the link and follow it through, and I hope to see you on there. So we're also on all sorts of social media, and you can click on the buttons there on the home page to join those different resources. We've got LinkedIn, Twitter, Instagram, Facebook, obviously YouTube, and we've recently added TikTok as well. And if you want to email me directly, get in touch directly, then use that email below there, info@thestopHunter.co.uk. So I hope that little taster has given you an idea of the sort of support and resource we can offer you along your trading journeys. Well, hey, congratulations, you've now finished the course. I hope you found it beneficial, but before we finish off, we've got a few more final pieces to cover off. So let's briefly summarise what we've learnt so far, and the first sort of takeaway, I suppose, a summary, is how great Darvas was at trading, really, and how he put together his strategy over many years of trial and error. And I'm hoping that his success as a retail trader has inspired you to try out his methods, and not just necessarily the box method, but how he put together a strategy, how he dealt with risk and the psychology of trading. And like it says here, that his methods are a great example of how to build, develop, implement a strategy in trading, and how to deal and conquer with probably the hardest element of trading, which is the psychological element, both of the markets and of the trader themselves, and how to build in risk and trade management processes essential for keeping the shirt on your back and the money in your bank. All round a really effective approach to trading, which I think could be used and applied by anyone in today's world. You've also seen how you can enhance and adapt the Darvas approach into today's modern world of trading. And although his idea was for stocks, US stocks to start with, we've seen that actually we can take it into forex, commodities, indices, other areas, and he was more of an end of day trader, and we can also now take his ideas into those different time frames, whether it's even longer term or even short term down to the minute type of charts and trading. And we've learnt how to put together our own trading plan and strategy built around the concept, and now all that's left really is for you to take this into your world of trading and investing.